The strange thing isn't that markets are falling. The strange thing is who's quietly leaving first. While millions of people are still arguing on television, celebrating new highs, and chasing the next hot investment, some of the smartest investors, founders, CEOs, and billionaires have been doing something completely different. They aren't running toward the future, they're heading for the exit. And almost nobody is asking why. If history has taught us anything, it's this: the biggest financial disasters never begin with panic, they begin with confidence. They begin with smiling headlines, record profits, and people believing this time is different. That's exactly what makes this moment so uncomfortable. Because behind the scenes, a different story may already be unfolding. Imagine walking into a massive concert. The music is loud, everyone is dancing, the lights are flashing. Then, without making a sound, the security guards quietly unlock every emergency exit. A few people near the stage notice. They don't scream. They simply begin walking away. The crowd keeps celebrating because nothing looks wrong. But the people closest to the danger don't wait for proof. They leave before everyone else even realizes there's a reason to leave. That simple difference has separated financial winners from financial victims for generations. But the real story was only beginning. The world's greatest investors didn't become wealthy because they predicted every event perfectly. They became wealthy because they understood one uncomfortable truth: survival comes before profit. They learned that protecting capital during uncertain times creates opportunities that don't exist during normal times. Every major financial crisis rewarded the patient while punishing those who believed risk had disappeared. Decades ago, this lesson repeated itself over and over again. Before the dot-com crash, insiders quietly sold expensive technology stocks while ordinary investors believed the internet had permanently changed investing. Before the housing collapse in 2008, a handful of investors noticed something wasn't adding up. They saw rising debt, unrealistic expectations, and financial products that almost nobody truly understood. Most people laughed at them until the entire system began cracking apart. What happened next changed millions of lives forever. The strange part about every bubble is that nobody inside believes they're living in one. During the excitement, every warning sounds negative. Every cautious voice looks foolish. Every person holding cash appears to be missing out. That's exactly why bubbles become so dangerous. They feed on confidence until confidence becomes blind. Today, something similar appears to be happening again. Artificial intelligence is transforming industries. Stock markets continue reaching extraordinary levels. Massive companies are becoming even larger. New technologies promise to change everything. The excitement feels limitless. Investors who stayed on the sidelines feel pressure to join before it's too late. Friends compare profits. Social media celebrates overnight fortunes. Everywhere you look, success seems effortless. But beneath the excitement, another picture quietly exists. Large investors aren't just watching headlines, they're watching liquidity, they're watching debt markets, they're watching corporate insiders, they're watching credit spreads, they're watching consumer behavior. Most importantly, they're watching each other. Because sophisticated money rarely moves alone. Imagine sitting inside a control room filled with hundreds of screens. Each screen shows a different part of the global economy. One tracks shipping activity, another follows manufacturing, another measures employment, another watches housing demand. None of these screens individually seem alarming, but together they begin telling a story that's impossible to ignore. And that's exactly how experienced investors think. They don't focus on one headline, they connect hundreds of tiny signals. This single difference changes everything. When uncertainty rises, smart money doesn't always sell because disaster is guaranteed. They sell because probability changes. Imagine playing poker. You don't fold because you're certain you'll lose. You fold because the odds no longer justify the risk. That's risk management. It's boring, it's disciplined, and it has quietly created some of the greatest fortunes in history. Ordinary investors often ask one question: how much money can I make? Experienced investors ask something completely different: how much can I lose? That small change completely transforms every decision because once money disappears, earning it back becomes much harder than keeping it in the first place. But almost nobody thinks this way until it's already too late. Then something fascinating begins happening. Company executives start selling portions of their own shares. Venture capital firms slow their investments. Large institutions quietly rebalance portfolios. Private equity firms become more selective. Banks tighten lending standards. None of these actions alone cause panic. Together, however, they begin painting an entirely different picture. But the real problem was just beginning. Markets have a strange habit. They reward confidence right before testing it. That's why late stages of bull markets often feel unstoppable. Every dip quickly recovers. Every setback becomes another buying opportunity. People begin believing markets only move upward. Eventually, risk itself starts feeling outdated. That's precisely when danger quietly grows strongest. Fear doesn't arrive overnight, it arrives one small disappointment at a time. A company misses earnings, another announces layoffs. Consumer spending slows slightly, manufacturing weakens, debt becomes more expensive, businesses delay hiring. Investors ignore each individual event because none appears catastrophic alone. But like tiny cracks inside a dam, their true danger comes from accumulation. Picture a bridge carrying thousands of vehicles every hour. Engineers notice tiny fractures underneath. Drivers see nothing unusual. Traffic continues normally. The bridge still stands. The city keeps moving. Months later, those tiny fractures become impossible to ignore. The collapse looks sudden to everyone, except those who had been studying the structure from the beginning. Financial markets often work exactly the same way. One of the greatest mistakes in investing is confusing price with value. During optimistic periods, rising prices convince people that value is also increasing. Sometimes that's true, often it isn't. A business can become more expensive without becoming more valuable. That's when expectations become dangerous. Once expectations rise too high, reality doesn't need to become terrible, it simply needs to become slightly less amazing. This is why experienced investors constantly ask uncomfortable questions. What happens if interest rates stay high longer? What happens if consumers spend less? What happens if artificial intelligence grows slower than expected? What happens if earnings disappoint? They aren't predicting disaster, they're preparing for possibilities. And preparation often looks foolish until uncertainty arrives. History repeatedly reminds us that liquidity disappears faster than confidence returns. When everyone wants to buy, markets feel limitless. When everyone wants to sell, buyers suddenly become scarce. Prices that looked stable yesterday begin falling much faster than anyone imagined possible. What happened next has shocked investors more times than people care to remember. During the financial crisis, businesses that looked unstoppable suddenly struggled to survive. Banks once considered untouchable disappeared. Families lost homes. Retirement accounts shrank dramatically. Companies laid off thousands of workers. The speed of the collapse surprised almost everyone because confidence had hidden the underlying risks for so long. But here's the part many people miss. Every crisis also created extraordinary opportunities. Investors holding cash weren't celebrating the disaster, they simply had options. While everyone else desperately sold assets at low prices, prepared investors could carefully choose what to buy. Cash wasn't exciting during the boom, it became powerful during the panic. This explains why sophisticated investors sometimes appear overly cautious. They understand opportunity doesn't disappear by waiting, it often improves. Missing the last 10% of a rally is far less painful than losing 50% during a collapse. Patience rarely makes headlines, but it frequently builds fortunes. Another silent warning often appears inside human behavior. During healthy markets, people discuss businesses. During speculative markets, people discuss stock prices. Notice the difference. One focuses on value creation, the other focuses on quick profits. Once conversations become dominated by overnight gains, financial freedom, and impossible predictions, psychology begins replacing analysis. Greed is a remarkable emotion. It convinces intelligent people they are immune to mistakes. It encourages larger risks after recent success. It whispers that caution belongs to weaker investors. Slowly, discipline disappears. Position sizes grow larger. Borrowing increases. Risk feels normal. Nobody notices because everyone around them is doing exactly the same thing. Nobody could have predicted what came next. The smartest investors constantly fight their own emotions. They know markets don't just test intelligence, they test patience, discipline, humility, and emotional control. The greatest enemy isn't inflation, recession, or interest rates, it's overconfidence. Because overconfidence makes people ignore information they don't want to hear. Imagine climbing a mountain covered in clouds. Every step upward feels exciting. The view becomes incredible. Then visibility suddenly disappears. Experienced climbers don't keep running toward the summit. They slow down. They check equipment. They examine the weather. They know the mountain doesn't care about confidence. Markets operate under the same brutal rule. Today, headlines often celebrate every new record, but sophisticated investors spend less time celebrating records and more time asking what assumptions those records require. Can earnings continue growing? Can debt remain manageable? Can consumers keep spending? Can optimism remain this strong indefinitely? Every bull market eventually reaches the point where expectations become nearly impossible to satisfy. Then comes the moment almost nobody sees coming. It isn't always one dramatic event. Sometimes it's simply disappointment. Growth slows slightly. Inflation refuses to disappear. Geopolitical tensions increase. Businesses reduce forecasts. Investors suddenly realize perfection was already priced into everything. That's when confidence quietly transforms into uncertainty. Once uncertainty appears, human psychology changes rapidly. The same investors who couldn't buy fast enough suddenly hesitate. Those who laughed at caution begin searching for safety. Financial television changes its language overnight. Optimism becomes concern. Concern becomes fear. Fear becomes panic. The transition often happens much faster than logic would suggest. Markets are ultimately driven by people, and people are emotional. We fear losing more than we enjoy winning. That's why selling accelerates during downturns. Every decline creates new fear. Every fearful decision pushes prices even lower. It becomes a self reinforcing cycle that feels unstoppable until it finally exhausts itself. But beneath every crisis lies another story. While panic dominates headlines, disciplined investors quietly return. They study balance sheets, they identify strong companies, they purchase quality assets everyone else suddenly hates. They understand that markets eventually recover, but only after optimism has been replaced by fear. This pattern has repeated through wars, recessions, crashes, inflation, banking failures, and technological revolutions. The names change, the industries change, the technology changes. Human psychology almost never does. That's why financial history feels strangely familiar, even when circumstances appear completely different. Perhaps that's why the smartest people aren't trying to predict tomorrow's headlines. They're positioning themselves so they can survive almost any headline. They diversify, they reduce unnecessary leverage, they maintain liquidity, they accept that uncertainty is permanent. They understand resilience often matters more than brilliance. The world loves stories about fearless risk takers who became billionaires. It rarely tells stories about the countless risk takers who disappeared completely. Survival isn't glamorous, it doesn't create viral headlines. But every long term financial success story begins with one simple achievement: staying in the game. Maybe that's the true meaning behind the quiet exits happening today. Perhaps these investors aren't saying the world is ending. Perhaps they're simply refusing to confuse confidence with certainty. They know markets move in cycles, they know every boom eventually meets reality, and they know preparation always feels unnecessary until the exact moment it becomes priceless. So, when you hear that some of the world's smartest people are quietly moving toward the exit, don't immediately assume they know something nobody else knows. Instead, ask a more important question: what habits allowed them to survive every cycle before this one? Because the answer isn't secret information, it's disciplined thinking. The greatest fortunes were rarely built by perfectly timing every market. They were built by protecting capital when everyone else became reckless, remaining patient when everyone else became emotional, and recognizing that opportunity often wears the disguise of uncertainty. One day, this moment will become another chapter in financial history. People will look back and wonder why the warning signs seemed so obvious. They always do in hindsight. But in real time, uncertainty never announces itself with flashing lights. It whispers, it hides behind optimism, it waits for confidence to become complacency. The smartest people understand something the rest of the world often forgets. The goal isn't to be the last person dancing when the music suddenly stops. The goal is to still have the strength, the patience, and the resources to dance again when the next song finally begins.